My name is Andrew Stotts, and I want to welcome you to the final presentation of Valuation Masterclass Bootcamp. This is going to be a presentation by one of our students. 6 weeks, maybe 150 hours of work, all comes together to graduate from Valuation Masterclass Bootcamp by doing this final presentation. Well, let's get it going. All right, how are you? Are you ready to rock?
Yes.
All right, let me just pull up your presentation.
Right.
And I think we're ready. So I'm going to remove myself in just a second and just make sure you can go down and up once just to double check. And then I think we're ready. Perfect.
Is it working fine?
Yep, it's excellent.
Okay.
All right. I am leaving now, so you can take over and start right now.
So namaste and good evening, everyone. My name is Lumanti, and today I'll present my equity analysis of AV Volvo. I initiate coverage on Volvo with a buy recommendation based on a target price of 336 krona, implying an upside of 23%. I derive my target price from a free cash flow to firm based valuation using a WACC of 7.8% and a terminal growth rate of 1%. So, the highlights are: firstly, slowdown in Europe and North America to curb revenue growth till midterm. Second, traditional vehicles to drive revenues. And thirdly, Volvo's shift to transport and logistics solutions could create a core competency. Likewise, the risks are cyclical commercial vehicle industry, competitive industry landscape, and regulations. So, let us now begin with a brief company background. Volvo Group was founded in 1927 and it engages in the design, manufacture, and market of commercial vehicles. The company has presence in 12 different countries and 150 markets. The major brands of the company are Volvo, Renault, and Mack. Now, moving on to the stories. The first story is slowdown in Europe and North America to curb revenue growth till midterm. Volvo's 70% revenues are derived from Europe and North America. EU truck market shrank by 7.5% in the first 9 months of 2024, which caused a 7% decrease in the company's revenue. Therefore, I expect a CAGR of 3% in revenues from 2024 through 2028. Now, the second story, geared up for electrification. However, traditional vehicles to drive the revenues. The market size of electric trucks is expected to grow as stringent regulations have been introduced all across the globe, especially in Europe and North America. Accordingly, Volvo is also ambition to reach a net zero greenhouse emissions by 2040, and it has accordingly made investment in battery plants and assembly plants. However, revenues from battery electric trucks were minuscule and less than 1% in 2023. Moreover, despite the regulators continuously pushing for electric vehicles, customer skepticism regarding BET and their efficiency, range, cost, and infrastructure still prevails. Therefore, I expect traditional vehicles to be the core revenue driver, which will also help Volvo in maintaining its OPM at 27%. Now, the final story, Volvo's shift to transport and logistics solutions to create core competency. As per IRU intelligence briefing, the global trucking industry is facing a significant driver shortage of over 3 million in 2023 across key regions. Volvo has recently expanded its autonomous solutions in Texas. It has partnered with Daimler for developing software-defined vehicle platform. It has also invested in Wabi Innovation Incorporation, which develops the next generation of autonomous trucking solution. This proactive investment and shift to transport and logic solutions could serve as a competency for Volvo going forward, in fact, helping the company reduce cost alongside providing an early mover advantage. Now, we have an industry analysis. Firstly, China is driving truck sales growth while Western manufacturers face a bumpy road. The global truck manufacturing market is expected to grow by only 2% in 2024, as the West is expected to be affected by excess capacity and weak freight demand. China and the APAC region is expected to drive global truck volume by 4%. As we can see chart in the right hand side, China has always been leading the heavy duty truck market development since 2019, and the same is expected going forward. This decade marks the dawn of electrified trucking and digital transformation. The shift to green vehicles and expanding sales services are the two key trends going in the trucking industry. According to strategy, and BETs are expected to constitute more than 20% of market share in 2030. Similarly, findings of an IBM survey also show that the truck industry executives expect the revenues from services to significantly increase going forward. Lastly, infrastructure and battery costs are the biggest challenges for adoption of electric vehicles. Despite the regulators pushing for electric trucks, the transition is challenging mainly due to high costs linked to battery technology and research needs. Range anxiety and long charging times also remain as a major concern for the customers. However, as we can see in the second bar diagram, registration of electric trucks are rising in Europe, and this is of course due to EU CO2 emission standards. Now, let us have a look at quarterly data of Volvo. We can note that the total revenue has decreased by 12% in third quarter of 2024. I also have a few latest developments relating to the company. The first one is that insiders have collectively bought 705 million kronas more in shares than they have sold in the last 12 months. Second, Volvo Trucks recently earned the highest safety rating of 5 stars. And third, Volvo Trucks plan to delay the start of construction of battery plants in Sweden. So let us now discuss how the market has been perceiving the company. 45% of analysts have issued hold recommendation, whereas the remaining 55% have issued buy recommendation. We can see that the mean target price is at 311, which is a 14% upside. Now, where is Volvo deriving its revenues from? We can clearly see that trucks and construction equipments are the major revenue contributors of the group, with a share of 66% and 19% respectively. Whereas with regards to the others category, which contribute to the 15%, it consists of Volvo buses, Volvo Penta, financial services, and group functions combined. Talking about geographical bifurcation of revenues, we can see that Europe clearly dominates Volvo's revenues by 43% of share, followed by North America, which is at 30%. So, based on fundamentals, valuation, momentum, and risk, where does Volvo stand? Volvo ranks below average relative to 180 non financial companies in Sweden. Fundamentally, Volvo is moderately attractive as it's backed by strong ROE and margins. Valuation wise, the company ranks top 20% as it trades on a low PE ratio, low PB ratio, and its PEG ratio is quite low. Well, Volvo's momentum is moderately unattractive, whereas its risk is quite high, as evident by high net debt to equity ratio, which is at 111%. Now let's talk about profitability growth. Volvo has maintained second rank since 2023. If we look at the bottom row of the pyramid, we can see that expense direction and expense control are quite strong, and these have been forcing Volvo to a stronger profitability and strong growth. So, this is the profit and loss statement of Volvo that I've projected. I anticipate a 9% decrease in 2024 revenues and a CAGR of 3% from 2024 through 2028. Next, we have balance sheet. This is the asset side of the balance sheet. I project the net fixed assets to increase consistently as the company operates in a quite capital intensive industry. Now, let's have a look at liabilities and equity side of the balance sheet. As we can see, a forecasted increase in long term debt to finance capital expenditure. So this is the cash flow statement that I've projected. Cash balances at the end row are decreasing from 2024 gradually due to increased internal fund usage in capex compared to the long-term debt. So, talking about ratios and margins, gross profit margin is expected to remain at 27% and EBIT at around 13%. This stems from Volvo's strong expense control and direction. So, net profit margin is expected to remain at around 9%, while ROE is expected to decrease to 23% in 2026. However, this is still a decent level, I believe. So here we have free cash flow data for the projected periods. Free cash flow to firm and equity both are expected to increase from 2024 through 2027. We can also see slight decrease in 2028. This is due to repayment of long-term debt. So now we move on to relative valuation. So based on PV to ROE multiple, we can see that Volvo's multiple for 2025 is estimated at 0.11 times, which is quite low compared to Sweden, World, and Asia, excluding Japan. This indicates that the company is trading at a significant discount. Let's have a look at PE ratio as well. We can see that PE ratio of Volvo is quite low compared to its peers, which also indicates that it is trading cheaper. Now we come to the final valuation. So I've assumed a cost of capital of 7.8% and used a low terminal growth rate of 1%. I also anticipate gross margin of 27%, leading to a value of 336 krona, which is a 23% upside. Now, this is the sensitivity analysis. So, if we assume the gross margins to slightly increase to 29%, the target price would become 361 krona. Likewise, on the pessimistic case, the gross margin is assumed to be 25%, yielding a value of 310 kronas per share. So, what are the risks that surround Volvo? The first is cyclical commercial vehicle industry. The commercial vehicle industry has generally been cyclical, although there is continued shift in the focus in commercial vehicle industry from product to now services. The cyclicality is still inherent in the industry. Next, we have competitive industry landscape. The truck market is highly competitive and Volvo faces intense competition from global as well as local industry peers. This might challenge the players to sustain revenue and their growth, which could ultimately affect their business, operational results, market shares, and financial positions. The third risk is regulations. Volvo Group is subject to environmental, occupational health and safety laws and regulations. In particular, regulations regarding emissions are extensive and evolving. These laws and regulations result in an often complex and uncertain environment for business and their operations. So, now to sum up, despite industrial headwinds, the regulatory pressure of shifting to green vehicles, Volvo's financials are strong, backed by strong margins. Likewise, PE and PV multiples also support that the company is undervalued and trading cheap. Therefore, I initiate coverage on Volvo with a buy recommendation based on a target price of 336 krona, implying an upside of 23%. Thank you.
All right. Excellent. We have some questions. Here's the first one from Momin. What would be the main catalyst that would push the price up to your target?
Uh, I believe the Volvo's expense control and direction is one of the major strength. Despite the revenues have decreased, Volvo's overall gross margins and net margins remain quite strong. That is the
Okay.
main catalyst that I believe.
Okay. And another question came in from one of our former students a long time ago, Jordan. And Jordan asked the question, which regions will be the main driver of the revenue into the forecast year? Any further insights you can give us?
While I believe since China is globally growing and it is definitely something the world is watching on, but competition is quite intense there. So I still believe Europe to be the major revenue segment for Volvo.
Okay. And we have two questions that come in that are related. Momin says, why was 2023 so special? Like, why was revenue so high? And
Yeah,
then Sahil says, why is your revenue dropping then in 2024, given that there was that high number in 2023?
yeah. The revenues in 2023 they were especially spiked because of the backlogged orders. Now, since the revenues have normalized now, I expect a decrease in 2024.
Okay, another question comes in from Indra. Do you mean increase in distance covered by electric trucks ranges to grow by 50%? Is mileage also going to increase for the company's trucks?
Do you mean?
Did you give us statistics about range for electric trucks?
I did not. I don't think I've given any range for electric trucks.
Right.
But as per my research, I've read that the ranges given by electric trucks is not very good. It's like you need two electric trucks to do function of one diesel power truck. That's
Mm,
why the consumer skepticism is growing regarding its efficiency and range,
right.
plus cost, obviously.
Okay. It says next one is the current decrease in sales at Volvo witnessed some of its regions like North America. Maybe talk a little bit about that.
Right. Right. In North America, it is especially due to freight demands that have lowered and commercial trucking. It's obviously depends upon the freight transportation as well. So that is the reason behind decrease in North America.
All right. Superwan Prow from our team said the industry page says that sales in China are expected to grow. Is there any opportunity for Volvo in China?
Yes, there is opportunity for growth in China as well. Currently, China's revenue contribute to around 10 percentage of Volvo's revenue. As much as there is opportunity to grow, there is also competition I see in China because Daimler, which is the largest giant in trucking industry, has a really good grip in China.
Okay. And also, we got a question from Kritesh who says, are you concerned about the rising debt levels?
Yes. Rising debt level is definitely, yes, it is alarming. But having said that, since it Volvo works in a capital intensive industry, debt are a must to expand operations. It is the cheapest cost of capital. So yeah.
Okay. And Jordan also asks, how do you see Volvo's competitive advantage as compared to China cheaper EVs?
So the competitive advantage that Volvo has as a brand I see is its safety and quality. Volvo is unbeatable in its quality and safety of products. It has earned 5 stars and 4 stars in their ranking. So that is, I believe, core competency compared to EVs in China.
And the last question coming in from Kritesh says, do you think Volvo and Mack can achieve their targets of 25 and 10% market share in North America?
Well, for Mac, it's a bit difficult because they've recently faced this supply chain disruption in Mac, because of which the revenues were quite lower than expected, according to the company. But they are obviously they're focusing on Volvo. So for Volvo, I believe they can, but for Mac, it's still a question mark. However, That should not be quite like alarming, because Mac constitutes comparatively lower revenue contribution compared to Volvo.
We did have one other question. What is your take on the partnership with Daimler Truck and Volvo? How do you think it will affect the company's performance?
Um, it is definitely for the better, because they're partnering on this software development platform, which is still an unexplored part in the industry. And having partnered with Daimler, which while Volvo and Daimler, they are the biggest player. So compare, like, partnering with your competitor, that obviously gives you an advantage, but that can also give you threat as well. So right now, considering the uncertainty, it's like 50-50. It's something the companies have better on, I believe.
Okay. How does it feel to graduate from the Valuation Masterclass Bootcamp?
Oh, it feels great.
Oh, the connection cut right at the moment that she said it feels great. Well, unfortunately, we lost her, but that was a great presentation. She did a great job. And I think it made me think about, what's going on at Volvo and Volvo Truck, and, whether it's worth looking at. I think it looked very interesting when I went through her research previously. If you want to build a competitive advantage in company valuation, well, join us at Valuation Masterclass Bootcamp. We'll see you